Lynda Schweitzer, how are you allocating assets in the Loomis Sayles Global Bond Fund, considering the strong dollar that a lot of analysts say is only going to get stronger?
We've been positive on the dollar for a while now. We have thought that the U.S. economy was the bright spot in the global economy, and especially with all of the quantitative easing that we continue to see out of Europe and out of Japan, we've been favorable on the dollar, especially against the two majors, the yen and the euro. We have slightly cut back on our short in yen versus dollars just because the yen has run more, but given the amount of quantitative easing that we expect out of Europe over the next 12 months, we continue to be short the euro and long the dollar.
Let's talk a little bit more about Europe. You can buy a German bond, however, you're not going to get any yield. So how do you manage in that environment?
It's really tough right now in Europe, given the technical that the ECB is in the market, the 60 billion per month that they're buying. It's hard to imagine that yields are going to sell off anytime soon, but negative yields are just really hard to have in the portfolio. So we're looking for alternatives. We're underweight Eurozone sovereigns overall. We're overweight things like Norway government bonds, Denmark government bonds, although those are getting pretty close to zero yields as well. About 40% of the Eurozone sovereigns now trade with negative yields. We're looking at corporates that offer a pickup. We're looking at agencies in the Eurozone that offer a little bit of yield pickup as well. But really, we can't be out of the market because it's a big part of our benchmark, but it's really tough with negative yields.
And you're also bullish on Australian bonds. Now, commodities have slowed down, and a lot of Australian commodities go to China, which is also slowing down. So why are you bullish on those Australian sovereigns right now?
We like the government bonds, but not the currency. And in our portfolio, we own the government bond market and have hedged the currency back to dollars. We think because of the slowing economy, mining and the terms of trade boom that Australia had because of the demand from China is really having a knock-on effect in that economy right now, and we expect that the RBA will cut a couple more times, which is good for government bonds. So we're very bullish on those, plus the fact that negative yields in Europe, Australia is a good alternative, but again, we don't like the currency and we've hedged that back to dollars.
And then finally, speaking of the emerging markets, the C is China, of course, and it seems like the BRICS are breaking up. You have India and China still growing, but Brazil and Russia having real problems because of lower energy prices. How do you manage in that environment?
Yeah, emerging markets is a tough thing right now, especially with the strength of the dollar. You've seen emerging market currencies be weak as well, some of it due to their own economic challenges, as you just outlined, but also because the dollar's been so strong. We think some of those economies are selectively good for dollar-denominated debt, and some of the corporates also offer some good values now. So it's very selective, and it's not all one way. So we're kind of looking through some of the opportunities there.
And then one final follow-up question. I mentioned lower energy prices, and that's hurting Brazil and Russia. So how are you managing with regard to lower energy prices? Because it certainly hurt the high-yield market this winter.
It hurt the investment grade market, U.S. investment grade market last year as well. About a third of the widening we saw over the course of 2014 was due to energy bonds. We had been fairly neutral corporates across all the different industries in our portfolios, but somewhat underweight energy. At the end of last quarter and here in the first quarter, we've started to opportunistically add to some of the energy names. We're in some of the double B or triple B names that are diverse players. They're low-cost providers, so even at these oil prices, or even if oil goes down a little bit more, we think they're still good values because they've underperformed. So we've been adding some of those to the portfolio.
All right, thanks a lot, Lynda.
You're welcome.